What is the difference between a fixed rate loan and an adjustable rate loan? What's the difference between a recourse and a non-recourse loan? So let's take the first things first. An adjustable rate mortgage, you may go in and buy a home. So you get a mortgage on your home. They're going to give you a 30-year amortized loan, but they're going to do a 5-year call or a 5-year adjustable rate. So if you have a 5-year adjustable rate, you get that loan at 5%. You're going to stay with 5% for the next 5 years. At the end of the 5-year period of time, your note will adjust to whatever the existing interest rate is. Now, some loans may lock that in for a few more years. They may not lock it in. You got to look at the terms and conditions of your loan. But some of them, I've had some loans that would do a 5-year call, and then I would be locked into that next rate for 5 years and then locked in again after that right there. So that is the difference between an adjustable and a fixed. So if I get a 30-year fixed rate mortgage at 3%, which we have a large portion, like 40% of the loans out there on houses today are locked in at a 3% or lower margin or interest rate. So if you got a loan locked in at 3% interest, are you refining? No, you're not. Are you going to sell that loan with a 3% interest rate and go buy another house with a 7% interest rate? No, you're not. You're going to keep that loan until you die or the government gives you a better opportunity to get out of it, because why would you do that? Whenever you go from 3% interest to 6% interest, your note is almost doubling. And you don't want to do that, so you'll stay where you are. But that is the difference between an adjustable and a fixed rate. Right now, would I do an adjustable rate at 7% interest? I would probably do it looking at the cycle that we're in, because I think we might see a climb in interest rates again, maybe 2 more times, I don't know. But then I'm hoping that next year we'll start seeing a little bit of interest rates coming down. And if they are coming down, then I would benefit on that. If they don't and they continue to get up, that would be a bad decision on my part, and I would not be in good shape. There's a lot of people out there that have some bridge debt. Bridge debt is, I go out and I buy a piece of property. Then after I buy a piece of property, I want to do a rehab to it. So I borrow enough money to buy the property and do the rehab. They don't lock in the interest rate on that right there. They're going to give you an interest rate that is good until your bridge loan is over. So if you had a 24-month bridge loan, that's going to bridge the gap. They're going to give you a loan from the start to the finish of your project. Then you got a refi. If that interest goes from 3% at the beginning of your bridge loan to 7% at the end of your bridge loan, then your note is going to be more. So if you're buying off of let's say you're buying at a 5 cap, so you're going to go in and you're going to buy a piece of property at a 5 cap with interest rates at a 2 cap or a 3 cap. Now you got a 2% spread on your money. But if that goes up to a 7 cap, now you got a 2% spread the opposite direction. That's going to cost you a lot of money, and that may cost you the ability to finance that loan. So if your numbers are somewhat tight, you won't qualify for the same loan at 6% that you would qualify for at 3%. So be real careful with bridge debt, especially at this particular point in time in our country, because we don't know what money's going to do. As long as the government's printing money, interest appreciation is going to keep going up, but there is no guarantee that interest rates are going to come down, because they're trying to stop the inflation in there.